I think for a lot of property investors, what they're actually looking for is a combination of affordable areas that have good levels of future capital growth. And really that's about finding areas where you're going from a variable level of supply to a fixed level of supply. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, code cracking stuff. We're going to go into land value principles, key economic principles when it comes to really understanding real estate, really understanding what makes great land. What are the components that we look for when we're out searching for a property investment? Today's show is all about asset selection, and really there's no greater asset than understanding the land principles in real estate. They are very key to success. So today is a big lesson. Welcome back, regulars. Play the show in double speed, get your life back. And of course, all the episodes I've done are in fact lessons on real estate. There's that word again. So feel free to go back in time. But hey, a few people in my world are doing good. One of my mates just wrote a book, Escape the Middle. Yes, it's all about escaping the middle class. Install your personal wealth financial system, your river of wealth. Good stuff. It's always good to see people that have been part of my life excelling in this world, writing their own books. Wonderful. And by the way, I have a book coming out. Will be out pretty soon, so I'll keep you posted. We've all gone back to writing books. How wonderful. But yeah, I've got a couple of mates who've now got a few books, which is good. Just looking for a couple on my shelf. There's my squeaky chair. I don't know, I can't see them. But it's always good to see people doing well in life, isn't it? I think sometimes we've got the old tall poppy syndrome in Australia. We start to bring people down when they're doing well. But I want you to do well. And one of the best ways you can do well is through understanding real estate, key economic principles behind real estate investment. Now, obviously, if you're going to understand real estate, if you're going to buy real estate and you're going to build a property portfolio, odds are you're going to also put into that property portfolio a mixture of dwellings. You're going to diversify. You'll probably have a couple of houses, maybe even an apartment or two. You're going to build this kind of portfolio to get you to your end place, which is typically working out how to use assets to replace your income. So along the way of that theoretical concept of building wealth, of ending up with financial freedom, of escaping the middle, we have to buy assets. And asset selection is really my primary focus. I actually run a comprehensive business which has all sorts of facets to it. We've got accountants that do people's accounts. We've got financial planners, property investment advisors. But my primary focus, my day-to-day, if you like, is really understanding the asset marketplace. And so if people ask me what I do, I say I'm in investments and asset selection. That's what I concentrate on every single day. So when it comes to housing, when it comes to real estate, really the principles behind it are important. I'm going to go through 11 really key principles when it comes to choosing assets around, in particular, housing. So the first principle is one of the oldest in the book, which is supply and demand. And obviously, the more fixed and finite a neighborhood, a street is, usually there's a correlation in property values. When land runs out, when homes run out, homes go up in value. So supply and demand is a really important principle. Value is derived from supply and demand equilibrium. But quite often in real estate, people shop on price, not value. And today I want to really go over the principles of value that are very different to the principles of price. And of course, in areas where land is running out, land will go up. And that may take a little bit of time. And if you're buying in an area where land is still available, you want to determine how long that availability or the absorption of that land will take. And sometimes it's less expensive to buy in an area which is still got land supply, but is starting to see homes run out or land run out. Really, a good junction point is to buy properties in areas which are being monopolized, but there's still a bit of room in those suburbs, which keeps prices down, which keeps things affordable. I think for a lot of property investors, what they're actually looking for is a combination of affordable areas that have good levels of future capital growth. And really that's about finding areas where you're going from a variable level of supply to a fixed level of supply. You're passing from one principle to another principle, which is really, really, really cool. But certainly if supply increases too much, property values come down. And so the ultimate driver of growth and value is an area which ends up during your tenure of ownership as a fixed and finite level of supply, which also induces demand. So that's the first principle. We're glad we got that out of the way. The second principle is the principle of anticipation. It is an important principle because the current price you pay is just a price, but it doesn't represent value. The value is the amount you pay today for future benefits. Those future benefits are the future growth on the real estate, the infrastructure improvements on the real estate, the expected rent into the future on the real estate, the rent gap on the real estate today based on the human beings in the area. Can you put the rents up? The principle of anticipation is so important when it comes to real estate investment. It's really not what you buy today, which is the important part of the puzzle. It's what you buy today that gets impacted over the years ahead, which is the important factor, the future benefits based around the value of what you're buying. And obviously investors sometimes shop on what's going on in the current 30 days that they're looking in the real estate market. And that's one of the challenges for a lot of property investors out there, or people shopping in real estate. When they get their finance approval, they go shopping. When they get their finance approval, they spend 6 weeks understanding real estate and walk away with a very expensive property. But value and price, and value and timing are two different things. They're very, very different to each other. So the first principle is supply and demand. The second principle is the principle of anticipation. The third principle is the principle of balance. Now, a lot of real estate has no balance. It's not near shops, it's not near transport, it's not near cafes, it's not near beaches, it's not in a quiet street, it's not balanced. And really, balance is about really this kind of harmony between the real estate, the land, the house, and the environment. The optimal land value, if you like, is achieved when the surroundings of infrastructure and amenity is balanced with the real estate on offer. And really an unbalanced place is a lack of essential services. And I see this a lot, particularly with the new land marketplace. There's a lot of new land corridors which have no shops, which have no Coles, which have no transport, which have no meaningful roads. They have no schools. They have no anything. And what you're starting to see and what I'm seeing is some pretty horrendous vacancy rates on the wrong piece of land, because the principle of balance is not in line with the asset. It's one of the most important principles. We talk about location a lot when it comes to choosing a home or an asset, and that is all known as the principle of balance. How does the environment work with the asset? It's a very important principle, as is the principle of conformity. Now, what you're looking for in real estate, and quite often looking for, is a house in a street. If you look at the most prestigious real estate and the most historical real estate, they're quite often in estates and streets where the architectural design of each home is very similar to each other. If you think of the Victorian terraces in Paddington, for example, and Edwardian terraces and tree-lined street, every home just is very harmonious. It's very similar to each other, but actually has its own characteristics and improves the consistency and style of a neighborhood. A property in that neighborhood which is completely different, it was for some reason built 100 years later, is going to be a lot less. It's going to be an outlier, and it won't get the value growth rate than the other more consistent homes in the neighborhood. And so when you're looking for an asset, you're actually looking for its characteristics to conform, but equally have some nice characteristics that maybe give it a little bit of individuality, but you don't want too much individuality on the asset. What you're really looking for is better land size or something that's more competitive for the asset. But really what you want is similar homes, maybe different designs, but similar look and feel. You don't want to drive down a street and there's a house falling down. There's one which is fibro, then there's one that's brick, and then there's a block of apartments, then there's some guys built a mansion and parks 3 cars on the front lawn. That's not conformity. That's confusion, and confusion will impact the value of real estate. It really will impact the value. It will impact your growth rate. And we know growth rate's a most important factor for capital growth. If you can get conformity, you will get value from real estate. Really, the next principle is the principle of substitution. And really, all the principle of substitution is buyers and investors will basically choose a property with the most use for the lowest price. And really, the principle of substitution ensures that really, for the most part, most people don't overpay by too much when it comes to real estate investment. You don't really see someone buy a property if all the properties are $800,000 for similar uses. Someone doesn't really pay $1.2 million for it. Someone might pay $850 for a property which may have some sort of hidden factor around it, but for the most part, the principle of value is driven in substitution. If the neighbor's home is of good worth, your home is of good worth. If your neighbor's appeal on their asset is of high appeal, and you follow that suit, there is no substitution. You will get capital growth. When there's too many variables and a lack of conformity and there's too much substitution, then the market doesn't know how to impress upon value upon the asset. And so we really want to understand this principle of substitution. Really, the next principle you want to consider when it comes to choosing an asset to drive that value is really external factors. The principle of externalities, external factors. And there are negatives that affect house prices. Things like power lines, a factory at the end of the street, industrial complex, at the end of the, roundabout that's 400 meters from your house. That's an impact of value. That is something that would create a negative appeal on an asset. And again, like external factors affect values and perception on real estate. They can be physical, they can be environmental. You can have environmental factors that push values down. That can be environmental factors, can be, prone to flooding, prone to bushfires, prone to drought. All of those factors, environmental factors, will have an impact on what people will pay and the capital growth rates you can extrapolate from an asset in real estate. So external factors such as overdevelopment, environmental, economic changes in your area, zoning changes in your area, all can affect the value of real estate. And so, of course, it's important to understand these variables. So when you're choosing an asset, you're making the right decision on its future benefit, its future growth rate. The principle of opportunity cost is also an important concept when you examined really the future benefit of real estate. Obviously, you've got some money to spend. You've got an asset you can buy. There's a certain amount of money you can borrow. There's a certain amount of price you can spend, leverage you can get into the marketplace. You want to make sure that you're buying the right opportunity in the marketplace. And really, opportunity costs dictate the money spent on an asset that you cannot use again. And I think it's where a lot of investors struggle to become wealthy from real estate. They buy not investment grade real estate. They tend to shop on speculative assets, quite often chasing price points in areas which lack conformity, which lack really the principles which I'm talking about, the economic principles of which I'm talking about today. So opportunity, you get it once, get it right. And that's why I always say one of the biggest factors of real estate success is the asset being selected. You can have the greatest mindset in the world. You can have the willpower in the world. You have the biggest budget in the world. You can read every book on real estate. You can attend every seminar on property. You can change your psychological well-being and become the most positive person in the world. And I've seen the most positive people in the world make terrible mistakes in real estate. The principle of investment is really a principle around how to use your opportunity well. You don't want to make a mistake when it comes to asset selection. Really, the next principle when it comes to choosing housing is the principle of consistent use. And this is an important one, the highest and best use of the real estate. The property's value should align with its optimal use, or you will get charged, you'll pay the piper for that. The check will be in the post for that. In other words, if you've got 500 square meters of land, the highest and best use for that would be to utilize that land with a big house, or it could be a house with a granny flat, or it could be a duplex, or it could be a nice double-story home. If you have a little shack on that nice piece of land, that will not derive value. Land value is assessed based on the highest and best use, and the improvements need to align with that use. And this is where you have a thing in real estate quite often called the land to asset ratio. The land to asset ratio is very important. We want a very good asset on some very good land. And quite often what I see is people so excited around land to asset ratio, they buy very good land with a very bad asset, and they never able to get the highest and best use out of the land. They're never able to extrapolate the best value from the land because they can't afford to knock down, rebuild, and they start to sit on an inferior dwelling on a very good piece of land. The ultimate consistency is the principle of consistent use. And this is where a lot of people end up with a hole in their back pocket, burning cash, paying for taps and toilets out of their back pocket, repairing things every single day. They bought some good land, but the improvement doesn't align with the use. And so the value is never actually activated on the land. There is no highest and best use ever used on the actual property. And of course, land and housing is influenced by the principle of change, And market conditions will always change. Economic factors influence real estate will always change. Cycles always occur. Everything is a cycle. And values will fluctuate over time based on market dynamics. That's the reality of it. In a booming market, values are worth more. In a declining market, values are worth less. After expansion comes contraction, but after contraction comes expansion. And of course, property values are influenced by that, influenced by changing market conditions. They're influenced by technology advancements. If you've got a better home and next to a less impressive home, the market will recognize that. Value will follow that. And so equally, you can have shifting demand patterns. The principle of land improvement can be influenced by demographic shifts. All of a sudden, people want to live in lifestyle suburbs. They're hugely popular. The value of land in lifestyle suburbs is shooting through the roof. The value of land in B grade, C grade, non-lifestyle dormitory places is not necessarily rising as fast as lifestyle suburbs. The principle of change is really what value investing is all about. As is the next principle, and I think I must have said principle 1,000 times, but we are doing the 11 principles you need to understand when it comes to asset selection, particularly around housing. It's the principle of contribution. Now, again, the right property will have the right inclusions. It will have the right kitchen. It will have the right bathroom. If you've got a property in a $2 million suburb, but inclusions that mirror a $500,000 suburb, you're not going to see the value uplift on the asset and the growth rate that you think you will. So the value of the components based on their contribution to the overall value proposition of the property, not necessarily the cost, is important. And again, like sometimes the principle of contribution equals the principle of renovation. And this is where, again, you'll see a property in a very good neighborhood has become run down, and it's got a 35-year-old kitchen. When the 35-year-old kitchen was 1 day old, that was the standard. Now that property market has risen by $1 million. The socioeconomic status of the neighborhood is attracting higher income earners. They don't want you to contribute to that asset by putting a laminated kitchen in and something pretty basic from Bunnings. They want you to value that there's a socioeconomic change and put a better set of inclusion, the principle of contribution. When people go to a property and fall in love with the property, quite often they're falling in love with the principle of contribution. The reflection the home gives them, the behaviors the home has, the little cheeky wine area, the pool out the back. These are the principles of contribution. Now, sometimes investors can't fathom why someone wants that stuff because it's seen as an irritant, but the principle of contribution creates a lot of value. Functional contribution, behavioral contribution, reflective contribution on an asset's worth. And a lot of that components behind that are the additional features, new rooms, facilities, and even in the apartment space. This is big in the apartment space. It's got the private dining room. It's got the infinity pool. The principle of contribution derives a higher principle of rent and a higher principle of capital growth. Obviously, when it comes to real estate, there is a principle of competition. What is the competition doing? And of course, the competition can be your neighbors. The competition can also be new supply coming to marketplace. And again, I see this all the time, that the right new piece of real estate coming to marketplace can quite often create a downgrading effect on the wrong piece of real estate. And so if you think about like the right, the right best new property which comes to marketplace, it's everyone wants it. And all of a sudden, people don't want what's nearby. They don't want the inferior asset. They want the superior asset. And really, one of the tricks to real estate is to make sure that you've got a competitive lifespan around your asset. And a lot of that pertains to property lifestyle, property life theory. So the life journey of real estate. And really what you're looking for is your real estate to not suffer from better real estate coming to market, downgrading your real estate. You really want your property life cycle to last 20 years, 30 years before you go through an impact of a correction of the value of your asset. And why often you see people buy rundown, tired assets is because the price reflects rundown, tired assets. Of course, if people use the principle of contribution and fix those assets, that's wonderful. But what I do see a lot is people buy rundown, tired assets based on basically getting them at a price, but never do anything to them, which is kind of like it's kind of like the oxymoron of the whole thing. So they're the things or the principles that you need to look out for. The principle of competition, the principle of contribution, the principle of change, the principle of consistent use, the principle of opportunity costs, the principle of externalities, which I can't say, the principle of substitution, the principle of conformity, the principle of balance, the principle of anticipation, the principle of supply and demand. So I hope that was helpful. Today was a bit of a lessony one. I should probably come up with some, some street talk. I feel like we haven't done a show on street talk in a while. So let me come back to you on that. But hey, thanks for listening, and you have a great day, and let's do this again next week. Feel free to share it with friends and family. We need more listeners. But thanks, folks. That's it from me. Over and out. Thanks for tuning in to the Urban Property Investor. If you enjoyed the episode, make sure to subscribe on your favorite podcast platform or YouTube so you never miss an episode. I'd love for you to rate the show and share it with your family and friends. Let's spread the word about property investing. Stay connected between episodes on Facebook, Instagram, and LinkedIn. And check out the rest of our podcast network at positivementor.com.au. And if you're serious about growing your property portfolio, don't miss our complimentary Property Investor Nights. Register now via the link in the show notes. See you next time.